Cigna is a global health insurer serving 188 million customers across 30 countries. Our recommendation is buy with a target price of $421, 45% above the current price of $291, derived from a 5-year DCF model built on deliberately conservative assumptions.
Cigna is the fastest growing managed care company in the peer group, yet it trades at one of the lowest multiples in the sector, a discount wider than at any point in the past decade. The gap exists because of temporary market fears, not permanent damage to the business. This presentation explains why. Cigna operates two businesses. Evernorth Health Services is the growth engine. Its primary asset, Express Scripts, is the largest pharmacy benefit manager in the United States, processing 30% of all U.S. prescription drug claims. Evernorth also manages specialty drugs, biosimilars, and behavioral health for 28.3 million members. It grew 16% in the fiscal year 2025, driving Cigna's full-year revenue to $274.9 billion. Cigna Healthcare, the traditional insurance arm, covers 15 million medical and 16 million dental customers. Two decisions define the recent period. In March of 2025, Cigna sold its entire Medicare business for $3.7 billion, before competitors absorbed catastrophic losses from that market. In October of 2025, it became the first major PBM to eliminate drug rebates, passing savings directly to the patients. Porter's 5 Forces confirms Cigna operates in a structurally attractive industry. The threat of new entrants is low, and Express Scripts processes 30% of all U.S. drug claims, a position that took decades to build and cannot be replicated. This is a genuine moat. The bargaining power of buyers is frequently misread as a negative, and switching pharmacy benefit managers is highly disruptive, interrupting an employer's entire workforce pharmacy access for months. The friction is precisely what makes Evernorth's revenues far more predictable than insurance premiums. Industry rivalry is genuinely high, but Cigna's integrated platform across pharmacy, specialty drugs, and behavioral health provides more retention levers than any single segment competitor.
To select our stock, we built a weighted scoring system, ranking every major managed care company across 7 metrics. Revenue CAGR, EV to EBITDA, and FCF yield each carry 18% weight, accounting for 54% of the total score. Cigna ranked first or second on 6 of 7 metrics, and first in all 3 highest weighted categories simultaneously, a result no other peer achieved. One note on Centene. Its 23.3% FCF yield sits beneath an EBITDA margin of only 1.5%, showing that the yield is not backed by genuine earnings power. On the other hand, Cigna's 8.5% FCF yield rests on a 4.7% EBITDA margin, substantive and recurring. Evaluated on quantitative merit alone, Cigna is the most compelling holding in the peer group by far. Why is Cigna undervalued? The scorecard raises the most important question judges will ask. If Cigna leads a peer group, why does it trade at a 7.7x EV to EBITDA while UNH trades at a 13.4x? The answer is not fundamental deterioration. It's 4 events that damaged sentiment while earnings kept growing. First, the failed Humana acquisition. Not buying Humana proved correct. Humana subsequently absorbed catastrophic Medicare Advantage losses. Second, PBM regulatory pressure. Cigna's rebate-free model is the most substantive voluntary compliance measure any PBM has taken. If reform accelerates, Cigna is already compliant while peers are not. Third, the Medicare exit was misread as weakness. CVS and Humana are still absorbing losses Cigna avoided entirely. Fourth, the rebate-free announcement triggered margin fears, yet Evernorth still grew 16%. None of these events broke the business. The stock fell, the earnings didn't. That divergence is the investment opportunity. The 3 investment theses. Their buy recommendation rests on 3 independent theses. First, valuation disconnect. Cigna's revenues grew 18.7% over 2 years, nearly double the nearest peer, yet trades at a 7.7x EV to EBITDA against a sector average of 9.5x. Re-rating to a sector average multiple implies 45% upside before earnings growth is assumed. Second, Evernorth as a structural compounder. Switching PBMs disrupts an employer's entire workforce for months, making Evernorth's revenue structurally more reliable than insurance premiums. The 2026 guidance of at least $6.9 billion in Evernorth pre-tax income confirms the trajectory. Third, exceptional cash generation. $8.4 billion in free cash flow in fiscal year 2025 represents an 8.5% yield, 2.5 that of Elevance's and above United Health's. $2.6 billion of buybacks in the first 4 months of 2025 compound per share value independently of any multiple re-rating. DCF valuation. Every assumption in the DCF was calibrated to be deliberately conservative. The revenue base of $274 billion is Cigna's actual confirmed fiscal year 2025 result, not a projection. The long-term growth rate of 3.5% is approximately one-fifth of the actual 2 years CAGR of 18.7%, an extremely conservative assumption. The most consequential assumption is the beta. Cigna's actual beta is approximately 0.5%. The stock moves roughly half as much as the market. We applied a beta of 1.0, however, more than doubling the risk premium in the discount rate. This was deliberate, to demonstrate the upside holds, even under conditions far more penalizing than the company's actual risk profile warrants. Despite all of these handicaps applied simultaneously, the model produces an intrinsic value of $421 per share. We stress tested the model across 3 scenarios, moving every assumption simultaneously in the relevant direction. The bear case assumes revenue growth of 2%, a weighted average of capital costs of 9.5%, and a terminal growth rate of 1.5%, all adverse inputs at once. Under these conditions, the intrinsic value falls to $316, still 8% above today's price of $291. This is the most important figure in the entire valuation. Most peers carry bear cases implying losses for shareholders. Cigna's bear case on their maximally adverse assumptions still implies a gain. The downside is structurally protected. The football field confirms this across 4 independent methodologies. The DCF, 52-week range, and analyst consensus all place $291 at or near the floor.
We present 4 risks with direct assessment of each. PBM regulatory pressure is rated high. The FTC has sued all 3 major PBMs, and 39 state attorney generals are pursuing structural reform. Cigna's rebate-free model is the most substantive proactive compliance measure any PBM has taken. It is better positioned than any competitor to absorb further reform. The rebate-free transition is rated medium. It compresses near-term Express Scripts margins, but the 2026 guidance of at least $30.25 adjusted EPS already accounts for this. Medical costs inflation is rated medium. The MCR reached 84.8% in Q3 of 2025. But the Medicare exit removed the sector's most concentrated exposure. The Shields Health integration is rated low to medium. Cigna integrated Express Scripts at $67 billion in 2018. A $3.5 billion deal is well within demonstrated capability. So what's next? The behavioral health network expanded to 28.3 million members in 2025, up 18% through a new government contract. The biosimilar program moved approximately 50% of eligible Humira patients to lower cost alternatives, measurable cost reduction at scale. The October 2025 rebate-free model is the most substantive voluntary transparency reform any major PBM has implemented, aligning financial incentives directly with patient outcomes. On AI, Evernorth deploys a machine learning to accelerate prior authorizations, the largest administrative bottleneck in U.S. healthcare. And to identify biosimilar substitution candidates, the principal AI risk is Amazon Pharmacy's direct-to-consumer model, to which Cigna's rebate-free structure is partly a competitive response. The investment case is clear. Cigna is the fastest-growing managed care company in the peer group, which leads on the metrics that matter most, operates in a structurally defensible industry, and trades at a decade-low discount created by 4 temporary events that left the underlying business intact. Evernorth grew 16% in the fiscal year 2025. Free cash flow reached $8.4 billion. The stock fell, the earnings did not. The DCF, built with a beta more than double the actual growth and a growth rate of 1/5 of the actual, still produces $421. The bear case, with every assumption stressed simultaneously, still yields $316 above today's current price. Our recommendation is buy.